what are your guys' thoughts when it comes to the politics and what role they play in markets?
So these questions is something our investment team definitely fields quite a bit. These questions are, I would say, valid, and they're completely warranted for a year like this year and all election years. And it's something that usually comes around every 4 years. It's not something we normally talk about following an election. When it comes to deciding how to invest in election years, it's a little bit of a moot point. When we go into November, when the election is taking place and the months following, we really see a decent rally in the market. And to the point, there's no sector or industry in which the president in office really impacts in a way that is knowable in advance. If that was the case, then I think our team would be doing that. Sure. But I think because of
everybody else,
right? And for the obvious reason, if it was that obvious, I think then everyone would be doing it.
Hello, Apriem family, and welcome back to episode 18 of Apriem Financial Cents. Now, for those of you that have been watching regularly, you know that we're right in the middle of a 4-part series that has set out to answer the question, what does a financial advisor do for me? However, we're right at the end of July, and second quarter's ended. A lot's transpired throughout the month of July here, and we thought it was really, really important that we get together, give you a bit of a market update, talk a little bit about what's going on with the election, as well as with the market. So I hope you enjoy this episode. I sit down with one of our senior portfolio administrators, Kenneth Wolin, and he gives us some feedback of what their team is doing. Hope you enjoy. We just finished out second quarter of 2024. Let's talk a little bit. I mean, what happened so far this year, and what do we see kind of happening as we move forward?
Sure. Sorry, I'm chuckling just because July's been crazy, and it's been an exciting and definitely I think an unexpected year. It's continued to be a good year for the top 4 or 5 companies of the S&P. But we're also seeing that starting to broaden out. The rest of the market looks like it's catching up a little bit.
Yeah.
We should see earnings broadening out. Bonds still look attractive. The fixed income market is not what it was, a decade ago. Yeah. And so I think that provides in a positive lens flexibility, and I think flexibility is good. And then on the side note, it is an election year, and so because of an election year, you have as we talked about, emotions running high.
Sure.
And then we have geopolitical, I think, uncertainty. And whenever there is uncertainty, I think it makes it a little bit more opaque into seeing where the market may go. But now that Q2 is over and we're now in the last half of the year,
right?
And people are coming back from their summer vacations, maybe we should see a little bit more movement in the markets potentially. But all in all, it looks to be on track like a decent year.
Yeah. So you mentioned it's an election year, right? And I've had a lot of conversations, and half the time people are asking, well, what do you think is going to happen with the market if XYZ president wins? Mr. So-and-so is the winner. It doesn't matter which one. I get questions on both sides. And I'm always getting these comments about, well, what's going to happen in the market, if they win, or what if they win? Or I'm really nervous about what's going to happen if so-and-so wins. Right? Do you think that is the right way of thinking about it? Or, what are your guys' thoughts when it comes to the politics and what role they play in markets?
So these questions is something our investment team definitely fields quite a bit. These questions are, I would say, valid, and they're completely warranted for a year like this year and all election years. And it's something that usually comes around every 4 years. It's not something we normally talk about following an election. When it comes to deciding how to invest in election years, it's a little bit of a moot point. When we go into November, when the election is taking place and the months following, we really see a decent rally in the market. And to the point, there's no sector or industry in which the president in office really impacts in a way that is knowable in advance. If that was the case, then I think our team would be doing that. Sure. But I think because of
everybody else,
right? And for the obvious reason, if it was that obvious, I think then everyone would be doing it. And I think we can look back to 2016 and see that wasn't the case, and we can look back to 2020 that people maybe had ideas of what industries would perform well or do well under certain presidencies, and I think the track history for that is relatively poor.
Yeah.
And when we look at this chart here, is We can see optimism during the Obama years from Republicans was not as high as the optimism that it was from the Democrats, and vice versa during Trump's years. It flipped. But when we look at the returns for these years, is they're relatively close. Right. And I think one thing we forget, and one thing I don't know if we say enough, is that the economy is not the market, and the market is not an economy.
Right.
Which is, it seems obvious, but it's very much so the case. And so we can't look at the economy and say it's an accurate representation of the stock market and vice versa, because they're different mechanisms, and they operate differently. The stock market is a discounting mechanism of the future, and the economy is relatively representation of what occurred a couple months ago.
Right.
And so
it's backwards looking.
Yeah. And so we can't really use one or another to say that they're the same. But when it comes to our team and deciding how we invest in the election years, is we don't pick a sector, we don't pick an industry, but we believe that staying in the market is ultimately the best choice we can make. And that's to say time in the market beats time in the market.
I think that's fantastic. Okay, well then how about, let's talk a little bit about, there's this heavy concentration that has happened this year with within the top 5 and 7 names really that are driving the markets up this year. And so that's great for anything that's market cap weighted, that's holding those top 7 names, those top performers. But how are we seeing? I mean, what's happening with the rest of the market? I know those are big, heavy drivers, but what about everybody else?
Yeah, well, we certainly have to acknowledge that it's been a market led by, I think, the top 5, 7 names, however many you want to count. And for good reason so far, as we can see. Earnings have kept up, and I'm not going to say it was led by necessarily the AI trend, but earnings and revenue is accurately being represented by these companies, and their stock prices are reflecting that by moving upwards. And so it doesn't seem it's necessarily completely overstated.
Sure.
But the focus, because it's been so narrow, the rest of the market has somewhat been forgotten. And there are other companies still performing this economy, doing things, generating revenue, beating earnings, and the rest of the market will catch up at some point. And the view of our team is that we do expect a broadening out. To say when, we're not entirely sure, but the consensus is that Q4 of this year is we're going to expect the rest of the market to kind of broaden out. And now that we're going into earnings seasons, we may have a better idea or expectation if that will be the case. We're only in week 2 of earnings season, so as more of our own names and the rest of the S&P start to report, we should get a better idea if that will be the case.
I think on that note of the broadening out piece, right? I've typically heard that over time you see these flows or these transitions where there's periods of outperformance of the S&P 500 index, which is market cap weighted, but then there's different periods of time where the S&P 500 equal weighted actually ends up outperforming those market cap weighted, and then it vacillates, right? It switches. Obviously, right now this year, those top 7 names. Magnificent 7 are driving, I believe it's something like 25% of the growth in the S&P 500 this year has come out of those top 7 names, right? But and so we're clearly in the camp where market cap weighted is outperforming. But are we seeing any kind of transition or change or shift there towards that equal cap? Really reflecting that the rest of the market is broadening out. Is that starting to be, I don't know, are we noticing anything there?
Word on the street is, and even conversations within our team, is that part of the reason why we can expect a broadening out is with the potential decline in interest rates. And we saw a pop this week in small cap and mid cap stocks, a significant pop, and a rally that was slowly building up. But the idea there is that if the Fed does cut interest rates, I don't know how many times, but if they do cut interest rates this year, it makes borrowing costs cheaper for smaller mid-cap companies.
Sure.
And the theory is that if these smaller, riskier companies, don't have as a large debt expense that they need to pay, then they can focus more on growth. And so a lot of these companies, a lot of these small-cap companies in the Russell 2000 had a good week. And so if all the focus is on these Mag 7, the big names, and interest rate comes down, we should expect some of the benefit of lower rates potentially benefit the smaller S&P names, the Russell names.
Yeah, there are 493 names that are out there.
Exactly.
They're only up
Right.
5-ish%.
And the names that we are talking about that are the Mag 7 are some of the biggest and strongest companies in the world. They have immaculate balance sheets. They have strong and wide competitive moats. And they've also had incredible and I think unprecedented performance that has caught a lot of the market off guard. When we talk about can the Mag 7 continue, I'm not sure. Maybe they can. I think that's it's indicative of earnings, and that's why earnings are so important for us right now to pay attention to, because that'll give us the most accurate and present indication. Are these companies keeping up with what they're saying that they're able to do?
Right.
So if we see revenue maybe start to trail, operating margins maybe shrink, if we see forecasts starting to weaken, that's going to give investors a little bit of a spook maybe, but it also may give an idea to investors to look elsewhere. Hey, I've had my wins in the Mag 7. I'm going to take my profits. I'm going to move on to the rest of the market that maybe has been ignored. We talk about behavioral psychology, right? And we talk about how investors can be very emotional. Well, when you have your best performers performing over and over again, it may be hard to leave those. But for the investors that have that conviction and ability to take gains off the table, say that was my win and move on, they may be looking for other areas of the market that have been unloved. And so with the remainder of the year and with potential rate cuts on the horizon, which we'll see if that's the case. We've seen inflation come in a little bit softer. We've seen initial claims and unemployment start to soften a little bit as well. If those become trends in a way that the Fed feels comfortable with cutting, we could be seeing a significant broadening out in the rest of the market. That also makes a great case for fixed income in the event that rates decline for our longer dated bonds. And so we've tried to make changes on the portfolio side to make sure that we're positioned for that in the event that that is the case. But if not, we're very happy clipping the nice yield that we are in this elevated rate environment. And to bring it full circle, there definitely is a lot of flexibility in this market, which I think for us portfolio managers and investors and with a large swath of clients to, I think, look over, that's a great tool to have in our toolbox.